Hello and a very big welcome to our latest live Q&A. I'm Emma Lou Montgomery and I'm joined today by Tom Stevenson and Ed Monk. All three of us are here to answer your questions and there is no shortage of those right now, is there? We're at the halfway point of the year and we've already been faced with challenge after challenge, from high inflation and rising interest rates to political turmoil here in the UK and war in Europe. So no surprise that we've already received lots of questions from you, including how to be more diversified, the outlook for bonds, and where to get an income in retirement. But I'm sure there are many more areas you'd like us to tackle too. If you haven't yet had the chance to submit a question, you've still got time. Just click on the Q&A tab on the screen here and we'll do our best to get through as many as possible. Now, just a quick reminder that this isn't investment advice. If you're looking for a personal recommendation, you can find out more about getting financial advice on our website. Right then, so let's crack straight on. And Ed, I think this one looks like something for you to answer here. So I've got someone here who's they're planning ahead, 30 years time horizon. What purpose do bonds serve?
What purpose do bonds serve? Well, that's a good question, particularly in the context of the last year or so, where bonds have not performed their traditional role as a diversifier for stock markets and shares. And so last year, bonds fell in sympathy with stock markets, which meant that many investors really suffered last year. So what role can they play in the future? Well, first of all, they can still be that diversified. Their role as a diversifier didn't end last year. Economic circumstances can change, and there are reasons to think if we get to a peak in interest rates and they begin to come down, then the bonds can recover a lot of that ground. And of course, one of the results of such high interest rates right now is that bonds are paying a high yield of interest at the moment. This questioner was talking about a 30-year time horizon. So that might affect their decisions. If it's a genuine 30-year horizon, for example, if they're saving into a pension and they literally can't touch the money, they may want to think whether they want to hold bonds at all. This comes down to their attitude to risk at the end of the day. But bonds should have a diversifying effect. That's certainly what they've done over the past 20 years. It's got a bit wrong in the last year or so. Okay,
great. Thank you very much. Question for you here, Tom. So someone says, I have a very diversified portfolio of funds, excellent, in various regions of the world in different sectors, but during the recent COVID crash, all the sectors seem to suffer the same amount. The question is diversification still worth it when you see that kind of thing happen?
Yeah, diversification is something that we talk about a lot, and the benefit of it. I mean, essentially the benefit of diversification is to answer the problem that we all face, is that we don't have a crystal ball. We don't know which assets, which geographical regions are going to do well at any given time. And I think at the moment it's even more important to be well diversified, because there's a huge amount of uncertainty, but also different geographical areas and different asset classes are behaving very differently. So, for example, we've seen very strong growth in parts of the US stock market. The Chinese stock market, European stock markets are not doing so well at the moment. So to cope with that issue, having a well-diversified portfolio always makes sense.
Yeah, absolutely. Okay, so question here, I don't know who wants to take this, but I'll put the question. Is there a product or fund for cash that could tap into interest rates? Obviously going up, so that's an issue to think about at the moment.
Well, yes, cash in general is paying a high rate of return. So how do you get an exposure to that? There are obviously cash savings accounts, but you do have to think about your wider circumstances there. Typically, the best rates on cash savings accounts are outside of an ISA. That potentially leaves you exposed to savings tax or the tax on your interest. But it can be done a different way. There are such things as money market funds, normally very sleepy, not particularly exciting funds that invest in short-term bonds, essentially, and other cash instruments to give a cash-like return. They've attracted a lot of interest in the last year or so because interest rates have been going higher. So that is one way to get exposure to that high levels of cash interest.
Yeah, we have seen our customers, haven't we, increasingly looking at these type of money management funds, which is interesting.
And it's probably worth adding that there are quite a lot of different ways now to to get a decent yield, which hasn't been the case for many years. With interest rates at rock bottom, it was actually very difficult to get an income from your investments, and that encouraged many people to invest in shares. But now there are many more options, money market funds you mentioned, but also government bond funds, super safe or relatively safe bond investments are offering very attractive yields at the moment.
Okay, great, thank you both. Okay, one for you, Tom. What are your top 3 equity funds?
Right. Well, I think that the stock market is in an interesting place at the moment. I mean, the US stock market has actually just triggered the traditional signal for a bull market. So it's 20% higher than it was at its low point last October. So that's encouraging people, I think, to look at global equity funds. And I think that's probably where I would start. And for many people, a global exposure to equities is the way to go. We have a couple of interesting ones on our Select 50 list. There's the BMY Mellon long-term global equity fund. That's quite an interesting diversified fund. It's got a bit of a technology bias. Things like Microsoft, things like Alphabet. So that's helped it do quite well recently, but it's got a good long-term record as well. Another one which we've talked about quite a lot in the past is the Rathbone Global Opportunities Fund. That's very much growth focused, so it's in favour at the moment. It's had a bad run in recent years, but in the last 6 months or so has done pretty well. Its largest holding is a stock called Nvidia, which we've talked about quite a lot recently because of its exposure to artificial intelligence. So very in vogue at the moment. So I think I'd settle on those 2 global funds for now.
Okay, yeah, no, like you say, we cover these all the time. Lots of equity, lots of fund coverage on the website too. People can sign up, obviously, to see what we're writing about, talking about on a daily basis as well.
Absolutely,
which is important. Okay, next question then. Okay, so I might actually take this one. So it says, I've inherited some money which I'd like to invest. Should I invest in one go or in stages? Okay, this is a question we've had a lot recently, I think, where people are sort of a bit cautious with market volatility, bit cautious, sort of thinking is now the right time to invest. And I think what we've seen is more and more of our customers tending to opt for regular savings plans and investing little by little, sort of drip feeding in. And of course, with an ISA, you can invest from as little as £25 a month, with a SIP, £20 a month. So I think if there's any sort of caution or wariness about when to exactly to invest, probably a good idea just to go for it and do it on a regular basis, take advantage of rising and falling markets for pound cost averaging and sort of like overall over the longer period getting a decent return.
Yeah, and just to add to that, I mean the point about drip feeding your savings in is that there's no surefire way of knowing whether that will get you a better return or a worse return. But the point about it is that you are going to average out the price at which you're buying these assets. That's what that pound cost averaging refers to.
Yes.
And if markets just were simply to go up, then honestly the best thing to do from a returns point of view would be to just have your money in the market for as long as possible. Yeah. But of course, where drip feeding really comes into its own is if markets are uncertain and they fall, because then you know that your next installment of savings are going to buy assets for a cheaper price, and that does help you return in the long run.
And it won't always benefit you, but I think there's a third element actually, which is just a psychological element. Actually, dripping your money into the market, it kind of forces you to invest when maybe you don't want to, because if the market's fallen, you might be nervous about where the markets are going, but often that can be a good time to invest. And if you're dripping your money into the market regularly over time, it just encourages you to do that.
Absolutely, and good to see that our customers are doing that in their thousands. It's a good approach to take, definitely. Okay, so I've got one here for you, Ed. Why are non-tech stocks in the US not joining the market rally?
It's a very pertinent question. It actually refers to some of the points that Tom has been making here. Okay, so non-tech stocks, they're the ones that are more exposed to the domestic growth in the US economy. And that growth has looked quite uncertain just recently. At the other end of the scale, you've got tech stocks, which are, of course, affected by economic factors, but a lot of their price is very sensitive to interest rates. That's why actually those stocks, those tech stocks, fell very badly last year, because interest rates were going up. That effectively erodes the returns and the earnings that investors think those companies are going to make years and years into the future. Now, get to this year, and those interest rate expectations are changing. We know they may not have peaked yet, but we know that rates will soon or at some point be falling. Investors are looking through that point and seeing more advantages in tech because their prices are going to again look very, very attractive. So will non-tech stocks join in? I think that really is going to depend on a broad-based recovery in the US economy. If we see that, then yes, we can see some of these value sectors return. But of course, in that scenario, interest rates might fall, and that's going to be good for the tech stocks as well. So, I mean, predicting it is really, really difficult. Diversification here really matters, and owning both sides of the equation.
And I think partly it's not just the fact that they're tech stocks or non-tech stocks. I think one of the features of these tech stocks is they're all very big, solid companies. And I think that at a time of uncertainty, investors will often gravitate towards, the big names that they recognize. And I think that's been part of it. I mean, there's been the AI shift as well. There's the interest rate factor. But part of it is just that these are big companies.
Yeah, and absolutely. And because we now offer US stocks on the website as well, it's just interesting and a huge market not to be missed. You can't ignore the US, can you? So good that people are looking and taking note of what's happening, and we'll see how it plays out this year.
Well, I mean, the US market represents about 60% of the value of global stock market. So you're absolutely right. You can't ignore it.
No, definitely not. Okay, next question here. Tom, one for you. We've seen some of the growth-focused stocks, e.g. Bailey Gifford's investment trust, come off recently with the fall in US tech stocks. Does Tom think this is a temporary setback for these funds or the start of a long decline?
We've kind of answered that question already, I think. I mean, to an extent, I think that it depends on what happens to interest rates, and it depends on what happens to economic growth. But the fact of the matter is that these tech stocks are an integral part of our lives now. I mean, they simply can't be ignored. And so I think it would be a very bold call to say that the declines that we've seen in some of those stocks is going to continue. And indeed, of course, in recent weeks, we have seen those stocks rally and return to favour. So I think that kind of answers the question.
I think even referring to them as tech stocks is slightly misleading as time goes on, because yes, they're very technologically driven, but they're exposed to all sorts of parts of the real economy, right? That are not to do with the efficacy of technology particularly.
That's absolutely right. I mean, when people talk about, sometimes they talk about different sectors, they talk about consumer discretionary stocks, for example, which in your mind you might think, oh, well, that's sort of retail and things like that. But actually, the most important part of that consumer discretionary category is Amazon. So is it a tech stock or is it a consumer stock? Well, of course, it's both.
Yeah. Okay. Right, so here we go. Another one. What are your views on the outlook for bonds held in SIPs over the next few years? Does the 60-40 rule still hold? Who wants to take that first? Maybe explain.
I'll go. So this refers to 60-40. That's
does it still hold?
Yeah, a long-standing portfolio split. 60% equities, 40% bonds, and that's supposed to represent some sort of magic formula of a well-diversified portfolio. We've touched on some of the factors affecting that already. Bonds didn't perform their diversifying role last year in particular. And the thing that really makes that very painful is that a lot of risk-averse investors who would have held large proportions, and 40% is a fairly chunky proportion in bonds, they would have been hurt the most. And some of the supposedly sort of safest portfolios would have fallen as much as some of the riskiest ones. That's why it's been so painful. But as we've said, that can change back again. And this is very much driven by the interest rate monetary policy that we're seeing. Rates are very high. That pushes the price of bonds down. That's why they've really suffered. But that can reverse. There's a huge question through this year about what that looks like and when it happens. But a lot of that effect can be undone.
Yes, and I was just actually reading in the press today that many professional fund managers are actually starting to to buy UK government bonds in particular, because the yields have risen so high. They are actually as high, or in fact a little bit higher than they were last autumn, when we had all of that political turmoil with the Liz Truss government and bond yields spiked higher. Well, they're actually higher today than they were there. Now, that's obviously bad news if you're looking to secure a mortgage, for example. But if you're an investor, locking in that high bond yield is very attractive, especially if, as Ed suggested, interest rates at some point start to come down again, because then you can add to that yield some kind of a capital gain as well, and you start to get a rather interesting total return. I think bonds look quite interesting at the moment.
Okay, good. Okay, I'm 72 years old and already in retirement. Should I take financial advice, Ed?
Well, potentially. You should, absolutely. At 72, I'm going to assume the questioner is in retirement. They may not be, but let's assume they are.
He said already in retirement.
Okay, and so it may well be that they have what they think is a fairly settled financial plan for their retirement. But without knowing all the details, it's impossible to know. But there still can be all sorts of ways in which financial advice can add value to your financial planning, even if you think, broadly speaking, you know where your income is coming from. This will all depend on the savings you have inside pensions, outside pensions, inside tax-efficient wrappers like an ISA, and outside of it, other forms of income. What financial advice can do is mix all those things together in the way that's, essentially the most tax-efficient it can be, to give you an income that's, if possible, free of tax, but if that's not possible, for your tax bill to be as low as possible. Obviously, Fidelity has a retirement service where its advisors are having those conversations every day. So potentially, yes, but if it all depends on the complexity of their finances.
Yeah, and I'm just thinking as well, this is probably not an unusual scenario to actually be in retirement now and thinking, hell, do I need advice? Because if anything, the cost of living crisis has shown that, you think you know what you've got to live with, and then it can really throw a curveball, can't it? So I should imagine there's other people here. So yeah.
And indeed, someone who is 72, it still has, many years of retirement ahead of them, potentially, and circumstances can change over a retirement.
And speaking to our advisors in our retirement advice business, they will tell you that things can change in terms of the rules governing your savings in retirement all the time. So the ongoing advice where they give that is often the most valuable advice. Yes, you have a plan from a financial advisor in the first place, but then ongoing advice keeps everything on track. You can adjust your income levels, your withdrawal levels from pensions, so that everything is sustainable in the long term.
So you're never too old to get advice, basically. Things can change. Great, thank you very much. Okay, can we use the proceeds from the sale of our holiday home to fund our pension? Do we need to be in employment to do so? Ed, that sounds like one for you.
Yeah, so the proceeds of a house sale for pension, well, yes, potentially. You have to, when you make contributions to a pension, your contributions in a year can be no greater than your earnings in a year. So if you earn £50,000 a year, you can't suddenly put £100,000 into a pension. So
with one exception, if you don't have any earnings, in which case you can save £2,880 into your pension and get a top up to £3,600. But
yes, true.
Broadly speaking, that's right.
Tom's been doing his homework.
He has been doing his homework.
But broadly speaking, you would need to be earning amount of money, notwithstanding what the exception Tom's outlined there.
Okay, no, great, thank you. Now then, this is one for all of us, I think. Where does the panel get their investment ideas from?
Well, good question. By reading a lot.
Yes.
I mean, there is, there are many sources of information. I personally rely heavily on our Select 50 list of our preferred funds, and that's because there are something like 3,000 funds on our platform. It's a daunting choice to have to decide which investments you're going to make, and that is the beauty of the Select 50, that it narrows it down with a short list of funds which we believe are strong funds in a range of different categories, and within that We offer growth options, income options, low cost options. So for a list of only 50 funds, there's actually quite a breadth of opportunity there. So that's a good
That is
first,
a good one. I mean, I always think that sort of looking at the most actively traded is interesting. And of course, to see what other people are buying. We, of course, run the top traded funds every month. We look at the most actively traded stocks. So I think that's another, really good source that I always look at to see what is moving in the markets.
Yeah, and I guess we're all in a position where we are very close to this information, and we are exposed to it quite a lot. But what we'll always try to do is sort of relay the best ideas that we come across and fund managers have, or what have you. And anyone signing up to our content through emails, what have you, is going to get exposed to that. I was going to make the point on this question really that you don't have to seek out very complicated or hidden or little known about ways to invest. In fact, I know many very, what they would be very sophisticated investors. They perhaps work in the industry, and they invest in the simplest, often low cost ways. And that's no sign that the return is going to be any worse. It's not the case that the more complicated your investments, the higher return you should expect.
No, absolutely not. And of course, we're covering this, like you say, every day. We're all over it. So we've got the daily pulse that goes out. We've got a plethora of other sort of newsletters and events like this, and of course your investment outlook that you do quarterly as well, Tom. So we give a lot of info, don't we, and sort of heads up on what is important for our customers to know about, really.
Yeah.
Okay. Right, moving on then. Tom, one for you here. What role should emerging markets play in one's equity portfolio this year?
Right, well, good question. I think, we've spoken about diversification, and I think clearly emerging markets have a role to play in a diversified portfolio. Emerging markets are home to a very large proportion of the world's population. They contribute quite a large proportion of the global growth in the economy. So it would be foolish, I think, to disregard that particular area when thinking about creating a balanced portfolio. Now, this year has been an interesting one, because I think that emerging markets have in some ways disappointed. I think as China came out of the pandemic at the end of last year, I think hopes were quite high that would be reflected in strong growth in the Chinese stock market. Hasn't really happened. The Chinese economy has not picked up quite as much as people expected. But emerging markets is a very diverse set of investment opportunities. It includes India. It includes commodity exporting countries like South Africa and Brazil. It includes a whole variety of different types of economies. So I absolutely think that an exposure to emerging markets makes a lot of sense.
Okay, great. Thank you, Tom. Okay, Ed, I don't think we covered this, but I've got another pension question for you here. Can I continue to pay into my pension after age 55 and just use it when needed?
The short answer is yes, potentially you can. I suspect the reason that the question is picked on age 55 is that is something called the minimum pension age. That's the age at which you can access pension savings without any sorts of penalties. That age is actually rising to 57, I think, in 2028. So yes, you can. However, the rules change if you've accessed taxable income from your pension already. So that's any money that you take from a pension outside of the 25% of tax-free cash that's normally available tax-free from your pension. Anything on top of that triggers something called the money purchase annual allowance. And that means that what you then can pay into a pension is restricted. So yes,
and it's significantly lower than the regular allowance.
Yeah. So the regular allowance, following some budget changes, is now £60,000 a year, and that falls to £10,000 once you've actually accessed taxable income from your pension. So it's a significant change. So it's worth bearing that in mind before you make any withdrawals from pensions.
Absolutely. Thank you, Ed. Right. Okay, so got one here. Can you have a few different ISAs if you stay within your yearly allowance? Right. So yes, you can have different ISAs. You could have multiple different sort of ISA accounts that you build up over the years, but you can only open one of each variety of ISA in any one tax year. So you could have a cash ISA, and you could open up a new stocks and shares ISA. You have a lifetime ISA, all opened up within, say, this current tax year. But you can also only invest up to a maximum of £20,000 across them as well. So I think that's important to remember. So you can't exceed it. But yes, of course, you can have a load of other ISAs, can't you, running from previous years? Might be good to consolidate, might not. That's sort of up to you, isn't it? Right, so another one here. Tom, I've got a question for you. So gold has been disappointing so far this year and the funds have not performed well. What is your view that funds that are what is your view, presumably off funds that are focused on gold in the next 12 months? Is this still a valuable investment to hold?
Well, again, coming back to our diversification point, I think there's merit in holding some gold in a portfolio because it behaves differently from other assets like shares and bonds. I think the issue with gold in the last year or so is that gold doesn't pay an income. And so it is particularly attractive to investors when it's difficult to find an income elsewhere. The opportunity cost of holding gold is relatively low. However, as interest rates have risen and people have been able to lock in attractive yields on bonds or money market funds or cash, then the appeal of gold is diminished. And I think that's what's happened. So I think I would say, yes, there is merit in holding gold for diversification purposes, and also because people tend to move towards gold as a safe haven. So if there's a lot of uncertainty in the market, then gold might do well. But there are a few different moving parts to consider.
Absolutely, thank you. Okay, so I've got one here. I already hold funds, but I'm thinking of investing in shares. So what should I be looking for? Well, I'll take this one to start with. I would say start with shares in companies that you know. You know, a lot of people do this, and it's a very good way of dipping your toe into the market, investing in funds. You get a feel for companies and how investment goes. And then lots of people want to get a bit braver as such and start investing in individual stocks, which is a great idea. But yeah, always go, I think, for companies that you know, companies that you're interested in, can understand, and that you can sort of see, you know, whether business is going well in that sector on the high street or wherever you're looking at, and that kind of thing. And I think the important thing when you're looking at investing in individual shares is, again, diversification. In a fund, you've got that built in. When you're investing in stocks, you don't want to put all of your money into one stock. You want to have a good sort of spread of money across different companies. So if there is one sector, if there is one company doing particularly well or not so well, you know, you're not adversely affected. So diversification is key. And of course, we run Stockwatch, so we've got coverage of all this stuff all the time. We look at the best-selling stocks and shares, but also we look at what's coming up in the month ahead, week ahead, and all the rest of it.
Yeah, I was just going to add though that it's not an either-or situation.
No,
I mean, lots of people will own funds and individual shares. But to your point, if you are only going for individual shares, then you need to make sure that you're not overexposed to any one company.
And I think the point I would make on buying individual shares for the first time, you know, the job of trying to predict share price movements over short periods is very, very, very difficult. I don't know if anyone can reliably do it ever, but what you can do is have faith in companies over a much longer period. So if you're really buying shares for the first time, do you really think that ideally you'll hold these shares forever or for all of your investing life, let's say? That should be the aim, rather than short-term things that, yes, it might go up in the next 6 months and I can sell it. I mean, those opportunities sometimes come along, but your aim shouldn't necessarily be that in the first place.
Yeah, I think there's a difference between investing and trading.
Oh, definitely, yes.
And I think for most people, that long-term investment horizon is the way to look at it.
Yeah, and presumably if this person's talking about already having funds, they are a sort of buy and hold investor, which is, as we've seen history showing time and again, haven't we, turns out to be the better sort of way to play. Okay, thank you. So here's another one. With interest rates for savings much higher than ever, is the stock market worth the risk? Now, we've had quite a lot of questions on this, and I mean, I think the thing to say is, yeah, great, cash is now actually earning money in the bank. So that's all well and good. But I think, and also I think within our accounts as well now, so on the ISA and in the SIP, we have actually started to pay interest. So when your money is sitting there dormant as such, you're still actually, you know, getting some growth out of it. So you have got time to sort of sit back slightly now and look at where you want to invest. But I think what you've got to always remember, of course, is what we're always saying, inflation, because that's going to really erode what's going on, isn't it, there? So if you're getting 3%, 4%, whatever on your cash, if you're looking at inflation, which is stubbornly high at the moment and just not really showing that much sign of going down to where we need it to be, you're going to have to get a
well, that's the key
rate.
question, isn't it? Is if inflation is to stay persistently high at or close to current levels, then you are losing money in real terms by holding money in cash. But arguably, you may also be losing money in real terms by holding money in shares.
Yeah.
But I think it would be wrong to just assume that inflation is going to stay at that level, because if inflation were to come down quite quickly, which is not beyond the realms of possibility, then some of the interest rates available on cash at the moment actually start to look very interesting.
Yes, and the Governor of the Bank of England was saying, I think yesterday, that it is possible, like don't hold your breath, but the inflation could drop quite significantly.
It's an understandable question, isn't it? When people see these high rates on cash,
Yeah.
what is the advantage of investing into the stock market? And listen, there's an asymmetry of risks here. They're not completely comparable. You don't risk losing money in nominal terms on cash, although, as you've said, you do risk losing it in real terms because of inflation. But stock markets this year, terrible year last year, but this year have added, maybe double digit, depending on your mix of different stock markets, but certainly the American market has been very strong. So yes, cash accounts look attractive, but so do the returns so far in this year, for example. So being an investor means that you do look through the short-term noise, even over a couple of years, to the longer-term outperformance of shares versus cash.
Yeah.
And that's why it can still be worth the risk.
Yeah, definitely. So it's a bit back to sort of diversification piece, isn't it? And also mix, so cash and investments, it's not one or the other. Just because interest rates are rising on cash doesn't mean put all your money into that.
It's about diversification. It's also about taking a long-term view. It very much depends on your view.
Yeah.
If you need your money in the next couple of years, well, then the stock market is not for you. If you're investing over a 30-year timescale, then that's a totally different question.
Yeah, absolutely. Okay, moving on then. So there were lots of pensions changes in the spring budget. This looks like one for you, Ed, then. What could a potential change in government next year mean?
Very, very good question. So, changes in the budget. Actually, changes in the budget and also changes previously announced in previous budgets that came into effect from April. So we've mentioned one of them already. That was the increase in the annual allowance for pensions. You can now put up to £60,000 into a pension. There's also changes afoot for the lifetime allowance. That was an amount of money, just slightly more than £1 million, which was the total that anybody could hold in a pension. That lifetime allowance is going to be done away with, we think. It will be legislated for this year and will come into effect next April. But even now, all of the penalties and the charges for breaching that allowance have gone. But there are also changes to CGT allowances, which were becoming less generous, income tax and what have you. Now, Labour, who's in opposition now but has head in the polls, many think might well be in power after the next election, have said that they will reverse a lot of these changes, particularly around pension allowances, the lifetime allowance, because looked at from a certain point of view, these are certainly advantageous to wealthy people who have lots of money to put inside pensions. So will they reverse it? I think you have to take at face value what they've said, that yes, they potentially could. The truth is, it's always the case with pension rules, any kind of tax rules, that they can change. And that's whether there's a change of government or not, they can change. What I would say is that if you're thinking of taking advantage of those changes now, putting more into your pension, planning around it, then I think it's much less likely that an incoming government comes in and somehow hits those people with extra tax. They may reverse the change, but that's not the same as saying, well, we're going to punish you for having taken advantage of something which is completely within the rules now. So it's an uneasy situation when you're trying to plan for the future and you know changes are going to come, but I think you just have to live with that reality basically and treat the system as it appears today, which is that these allowances have been expanded.
Okay, so do what you can do now with what we know now and then see what's next to come. Okay, thank you very much, Ed. Right, so I've got another one here. How should a 30-year-old invest now if the main goal is to retire comfortably at 60? So who wants to start on that one?
Well, so okay, so this is the 30-year investment horizon.
Yep.
So I think that this, many of the answers that we've already given sort of feed into this question. Partly about diversification, partly about investing for the long term, and that means investing in the assets which historically have performed better over the long term. No guarantees that will happen in the future, obviously. But if you were investing for a 30-year period, I would suggest that you would have a bigger exposure to shares than you would to lower risk, but potentially lower return assets, such as bonds and cash or cash-like investments. So I think if you're on a 30-year time horizon, you're probably quite heavily exposed to shares. And I think that you can think about investing in some of the potentially more risky parts of the world. So you might want to have a slightly bigger exposure to emerging markets, for example, than you would if you were investing for a shorter time.
And that addresses where you might put your money. But to address the point about how you get to this point where you might be able to retire at 60, that means retiring early. And obviously in 30 years' time, 60 is going to feel very early for retirement because retirement ages are getting later and later. You're going to have to save aggressively. So if we treat this as someone who doesn't have any savings of note at 30 and wants to retire at 60, you're going to have to save quite a significant amount of your salary. I can't do the numbers in my head, but it's going to be in and around 20% of your income that you're going to have to save. Certainly more than the levels had you been 20 years old or 22 or something. Yeah. The fact that starting at 30, you have missed a few years. And the other thing I would say is that obviously you've got to save a high amount of your income, but you don't have to start with very, very hefty amounts. You can escalate it. And so if you're saving maybe 10%, maybe next year, tweak that to 11, the year after to 12, to 13. You would be surprised how quickly you can get up to these big numbers. And doing it that way, you don't have this sudden shock of sacrificing lots and lots and lots of salary, lots of income now, which will feel very, very painful. And just to add, it's a good ambition to have. It's hard to do, but it's good to set those kind of ambitious goals.
But the key thing is to get started, because time is your friend when it comes to investment.
The thing that sprung to mind there for me was thinking about the sort of gender differences here as well. We don't know if this is a male or female who's put the question, but 30-year-old, if that's a woman, that could be the age they start having to take. It's typically women, isn't it, who take sort of career breaks and stuff like that, either to raise a family or end up doing that for sort of looking after elderly relatives and stuff. So for women in particular, I think this person would need to sort of really supercharge, especially if they're female, to sort of bridge that typical gender gap that you end up with at retirement age, where women so often have significantly less than a male counterpart of the same age.
And on that point, absolutely maximise all the help you can get. So if you're saving into a pension, make sure your employer is saving the maximum they're willing to save as well. And also ensure your national insurance record is completely up to date. And that's very relevant for people who do take career breaks, because that will ensure you have a full state pension. Now, you might want to live on an income that far exceeds the state pension in the future, but it's very, very valuable. Guaranteed, inflation-protected income in retirement. So you should maximise that. Yeah,
absolutely. Okay, so here's one. As I am new to this, I'd like, if possible, to know how all of this works and what I can do to make the most out of my money. So, well, whoever this is, welcome aboard. You've made a very wise decision to get invested and make the most of your money. So who wants to go from there? Tom, any tips for newcomers?
That is a very broad question, isn't it?
It's very broad.
That's how it works. And I think we've covered many of the issues.
I would hope so.
Yeah, I would say, if it really is let's take it that they are new to investing, there are various things you could do to check that really you are ready to invest. Clearly, this person has an interest in it, but you can ensure your finances are in a place where you should invest. So that typically means no debt, certainly no debt beyond mortgages, student debts and mortgages, let's say. But if you've got unsecured debt or other kind of debt apart from that, you should probably concentrate on clearing that first. And then to build up some cash savings. We've spoken a lot about cash, but this isn't cash really for a return. This is cash to ensure that if you need money in a pinch, you've got it. So that's money to cover, in a worst case scenario, loss of income, that kind of thing. So maybe 3 to 6 months worth of income you save in cash. If you've got all that, then you're potentially ready to invest, and just, throw yourself into researching it and finding out about your own attitudes to risk. Think about how you're going to be able to handle losses when they come along. It's really difficult to know that in advance until it actually happens, but be aware that that's all part of investing, and then honestly start. That's the best advice.
Okay, thank you. Right, so here's one. How to best invest on behalf of your children? Well, I'll start here, I suppose. The two main ways to do that are a junior ISA, and you can invest up to £9,000 on behalf of a child in that, and otherwise junior SIP. And of course, you don't have to be an earner, like you mentioned earlier. Anybody can invest up to $2,880 for anybody, including a child. That's then topped up with tax relief. It makes it worth $3,600 a year. So that's two really, really good ways to set your child or a child up for life, really, financially.
And actually, when you look at the numbers of how returns are compounded over long periods in something like a junior SIP, for example.
Yes.
And clearly this is money that's not going to be touched for decades and decades. Yeah. But you can build incredibly impressive numbers on relatively small contributions on behalf of a young child, and that's simply a function of what happens to investments over time.
Yeah, and having that very long-term time horizon is fantastically powerful, and it does alter how you think about your investments. It does allow you to take slightly more risk because there's plenty of time to ride the ups and downs of the market. Yeah. And so I think, don't be too cautious, I would suggest.
Which can be counterintuitive, can't it? When you're saving for a child, because you don't want them to lose money, no one likes the thought of that. You do have time on your side, so you should be able to take on more risk. But at the other end, you need that exit plan, don't you? Perhaps de-risking, working out what use this money is going to have. Is it for them to travel the world, buy a car, buy a house? In which case, you're going to want to have it invested correctly up to that point, which might mean de-risking it.
Yes, absolutely. Yeah, the time horizon is going to differ. There's a world of difference between saving for a child's university education or their first house deposit and their retirement.
Yes, of course, if you're saving into a junior SIP, you're not going to be there to see what they do with it, but what a fantastic gift to give a child, really. So fantastic, yeah. Okay, I think we're pretty much out of time. I've got one very quick one, which you can give us a really quick answer to, Tom. Right. It says, what are Tom's views about Japan? Is it time to invest once more? If you can give me a quick answer on that.
Yes,
one.
Absolutely. Well, Japan, I think, is an attractive market. It's quite a cheap market relative to more popular markets like the US. Japan has come out of COVID in good shape, slightly later than the rest of the world. So it's still seeing the benefit of that in terms of, for example, growing tourism. And so I think for a combination of reasons, Japan looks quite an interesting stock market at the moment.
Fantastic. Thank you both very, very much indeed. Right. And that is all we've got time for. Thanks from all of us here and for all your questions. I'm sorry if we didn't get through all of them. We did get a lot of questions today. So hopefully we answered some of your questions there for you. If you don't want to miss out on future events, or if you want to hear more from me, Tom and Ed, and the rest of the team, sign up for our regular emails at fidelity.co.uk. Thanks very much for watching. Goodbye for now.